value is $88.50. Right, there it is, $88.50 right there. So we told you that that's where the value was. Look at where the price went. Boom, straight to $88.50 before pulling back into the pre-market London. Since then, we've been buying and selling into this. We've been taking both sides of the trade. We did a bit of buying. We did a bit of buying in here with the accumulation trade from the pre-market Brent here. We got a very nice lift off that price with targets. We got the dealer inventory level that we were selling into, and we had a brilliant dealer inventory level, 89.20s down to 88.20s for another near $1,000 sell-off. And we've been buying some bottom edges. We've been rotating into some shorts. We've been doing a bit of business in a lot of different locations, and it's just gone kind of grubby for the moment in the middle of a balance area, developing out value, but we're obviously just going to have to wait to see how this plays. Now, in terms of the dollar, you can see I'd rather be buying oil against the dollar, of course, so there we go. I'd rather be long the oil at lower prices, so that's the first thing. The second thing we can look at is, are we trading the purple line on the buy or the sell? If you look at the purple line based on what we can see from this balance area, I think you can probably agree with me that we'll be selling the purple line. That means buying oil. So we've now got the two main pieces of information for this little balance area, suggesting we should be bidding lows. Okay, so we start watching level 2 liquidities. We start watching into these level 2 liquidities for still the short-term storyline to stack up for those as buyable opportunities. Very straightforward, guys, very straightforward. I would draw your attention, however, to the very important news about non-farm payrolls. You might be saying, but why would that have any impact on my oil price if I'm trading oil? Because obviously it's going to have an impact on dollars. It's going to have an impact on, therefore, every single commodity on the planet. So you've got to pay attention to non-farm payrolls. Non-farm payrolls coming out at 1:30 today, guys. The forecast is for a headline of 295,000, the prior of 528,000, unemployment rate of 3.5%, average earnings at 0.4. So obviously slightly softer than last month's, Last month's was a 528 print. This month, 295,000, and the average hourly earnings last month were 0.5, and this month 0.4. So slightly softer than last print, but remember, it's not about that, it's against the forecast. So make sure you pay attention. We are looking at long oil trades, so obviously it would be in some ways beneficial, but it's not going to be directly impacted. Okay, it's not a direct impact, it's whatever the dollar does. So obviously a hot number coming in from non-farm employment numbers, you might see the dollar popping. If the dollar pops, there might well be an initial sell-off on oil, but that's not necessarily going to be a longer-term trade. Why? Because obviously if you're getting a hot US economy, you're getting demand coming in for oil. So therefore, it might be a hot, you might get a hot pop to the downside, but it might well give you that perfect opportunity to re-engage with the long side of your oil trade if the value still says be long oil at these lower prices. So that's going to be something that we could be watching for based around the dollar narrative itself. But that's coming out, guys, at 1:30, which is in just 20 minutes. And that's we'll be, as I said, paying attention to that. We also had a shout. We also had a shout for sell side only bonds, and we did get under a little bit of pressure on bonds. We did get under a little bit of pressure on bonds at higher prices here, and we've done a few sells coming in off this area. I am currently flat bonds for the moment, guys. I'm currently flat treasuries. I haven't been able to, we sold again in here. We got some profits and we scratched out. I haven't resold it. You might be thinking that looks like a really good sell, but I didn't take it. Okay, so I stopped my selling at that stage. And there is a couple of reasons. Reeve actually mentioned one of the main reasons. The 2s 5s. The 2s 5s was starting to curl quite significantly in favor of, see the difference in the two curves here? Well, of course, if the 2s 5s are dropping, that's going to put a short-term buyer into the bottom edges. And it would have been reasonable to consider this as a buy trade when the candle closed here. So you could have easily have thought about this as a buy trade at 27s on the candle close. Nothing wrong with that as an opportunity. Now, obviously, that's a bit bold. Why? Well, because obviously we've got a very, very big lift up on the 2s10s, so you can obviously look at that and say, my God. And if you look at the 2s10s about where it is against its previous levels, this doesn't represent a big discount, does it? So if I look at the 2s10s from there to there, and I draw pretty much the similar line here, right? So if I draw a very similar line without giving us too much of a slope, which is what we're getting at the top edge, you can see I'm not really reaching that discount price, am I? Now in the 2s5s case, I think we could all agree we definitely are reaching a discount, but in the 2s10s we're not. So there are questions about what's going on in here, and you would need to add some other quality to this. You'd need to add some other value to this. Now, we've already talked about buying oil. So that's obviously one quality that's against the buy trade here, because if we're buying oil, you would imagine if you're buying oil in these downticks potentially, then of course, you know, that's going to put some sell pressure in here, but we do have a discount to the current oil price. So that's something you'd be looking at and saying, well, perhaps this would be an inflation hedge trade. So where you're buying the bond and you're buying oil puts you into an inflation hedge narrative, doesn't it? So that could be one option. Another opportunity would be the dollar, of course, and you can see that the dollar is very negative for bonds at the moment. That's one of the reasons why, you know, why I've not been buying into it as well. The Japanese yen is very, very negative. This has probably got back to fair value. Probably got back to fair value in terms of the dollar. So for me, for the time being, I'm still flat, guys. And if I miss the trade, I miss the trade. But that was my play on it. That's my view on it, and I'm quite happy to just be on the sidelines. But you know, Reeves' point is valid. The 2s5s is usually you know, especially when we're coming into data like this. The STRS boys obviously are connected to the direct dealing desks. The direct dealing desks are connected to the Fed. The Fed knows what the non-farm payrolls are going to be, so they already know what that number is. And the STRS boys get a little bit of a nod and a wink, and sometimes you see that that 2s5s moving and diverging against the 5s10s or the 2s10s. So you can see the STRS boys are bullish bonds, and they would certainly be keen to be exposing perhaps a little bit of an opportunity to buy into this. And that's where the buy trades may be coming from just now. But not for me at the moment, guys, not for me at the moment, but happy to be proved wrong, Reeve. Happy to be proved, well, I'm not wrong because, you know, I don't have a view on it at the moment, so I'm going to be proved right to not have a view or whatever. But anyway, that's where we're at just now, guys. That's where we're at just now. So welcome in, welcome in. It's Friday. It's the final day of predominantly the oil markets and the bond markets. So that's the quick starts for oil and bonds coming to an end. We'll obviously be focused on oil and bonds this afternoon. We'll be looking at those two markets. And then today at 4 o'clock on the classroom, we'll be looking at oil, bonds to round up the quick start guides on those two markets ahead of next week's, which are going to be gold and Forex. And then from that point onwards, we're going to be focused on specific trades that are happening each day. So it might be on oil, it might be on Forex, it might be on bonds, but we'll be focusing in on whatever trades are perfect examples of benchmarks. So it doesn't matter what market it's in. We want to make sure that you guys will see the perfect benchmark trade often, because it's important you see lots of these, so that you can start tying in the concepts with the actual trades that are getting done. You can start to see the trades, you can start to understand that the trades are exactly where the trades should be. And on that basis, you can start to make the decisions on the right-hand edge based on those trademark concepts, those little signposts that mark the big trade opportunity. And that's what we're really looking for in the next phase of your classrooms following the gold and following the Forex markets next week. So welcome in, guys. Be very, very careful. If you're not in a position or if you're not sure what you're doing, stay well away. This is always a big impact data release. Non-farm payrolls in 15 minutes. 15 minutes, guys. Non-farm payrolls.